Chapter 20, Output, the Interest Rate and the Exchange Rate. In Chapter 18, the exchange rate was treated as a policy variable. In reality, the exchange rate is determined in the foreign exchange market. In this chapter, we look at these two questions: what determines the exchange rate and how can policymakers affect it? In this chapter, we study the simultaneous determination of output, the interest rate, and the exchange rate through equilibrium in the goods market, the financial market, and the foreign exchange market in an open economy. Learning objectives. Understand what is meant by equilibrium in the goods and financial markets. Become familiar with the assumptions and simplifications in this chapter. Understand the interest parity condition and what it implies about the relation between the interest rate and the exchange rate. Understand the open economy version of the ISLM model. Learning objectives. Explain the effects of fiscal and monetary policy in the open economy under flexible exchange rates. Discuss the role of monetary policy under fixed exchange rates. Examine the effects of fiscal policy under fixed exchange rates. Equation 20.1 gives us the IS relation in the open economy or the equilibrium condition in the goods market in an open economy. It says output Y, left side of the equation, is equal to the demand for domestic goods given by the right side of the equation. Implication of equation 20.1 is that both the real interest rate R and the real exchange rate epsilon affect demand and in turn equilibrium output. Equation 20.2 is derived from equation 20.1 by making two simplifying assumptions. In the ISLM model, domestic price level is considered fixed. The same assumption is made for the foreign price level. This makes the real exchange rate epsilon and the nominal exchange rate E move together. Secondly, because of fixed prices, actual and expected inflation is zero. This makes nominal interest rate I and real interest rate R the same. Equation 20.2 says goods market equilibrium implies that output depends negatively on both the nominal interest rate and the nominal exchange rate. Now let us look at the equilibrium conditions in the financial markets in an open economy. In a closed economy, we assumed people choose between two financial assets, money and bonds. In an open economy, they have to make an additional choice between holding domestic bonds or foreign bonds. Money versus bonds. Equation 20.3 gives us the LM relation. It is the equilibrium condition for the determination of nominal interest rates in the open economy. It is the same as the condition for a closed economy. The interest rate must be such that the supply of money and the demand for money are equal. In an open economy, the demand for money is still dependent on the level of transactions determined by real output Y and the opportunity cost of holding money given by the nominal interest rate on bonds. Domestic bonds versus foreign bonds. Equations 20.4 and 20.5 have been derived from the interest parity condition. They give us the answer to the question how exchange rates are determined. The relation tells us that the current exchange rate depends on the domestic interest rate, the foreign interest rate, and the expected future exchange rate. Equation 20.5 implies a positive relation between the nominal exchange rate E and the nominal interest rate I. Consider an increase in I. This would make domestic bonds more attractive. Financial investors will switch out of foreign bonds and into domestic bonds. To buy domestic bonds, investors must first obtain dollars. This causes an increase in the demand for the dollar. The increase in the demand for the dollar causes an increase in the price of the dollar. The dollar appreciates, E increases. Hence, an increase in I causes an appreciation, an increase in E. Equation 20.5 also tells us if I increases by 2%, this will cause the dollar to appreciate by 2% today. An increase in I of 2%, given that the expected exchange rate a year from now remains unchanged, means that the dollar is expected to depreciate by 2% over the coming year. This expected depreciation of the dollar corresponds to a 2% appreciation of the foreign currency, say pound. In fact, the pound must be expected to appreciate by 2% to compensate for the 2% increase in domestic interest rate I. Similarly, an increase in the expected exchange rate, keeping I and I star constant, leads to a 1-for-1 increase in the current exchange rate E. Figure 20-1 shows the relation between the interest rate and the exchange rate implied by interest parity. A higher domestic interest rate leads to a higher exchange rate and appreciation given I star and expected exchange rate. The interest parity IP relation curve is upward sloping. Equation 20.5 also implies that when the domestic interest rate is equal to the foreign interest rate, the exchange rate is equal to the expected exchange rate. E equals expected exchange rate. This implies that the line corresponding to the interest parity condition goes through point A in the figure. Figure 20-2 shows the ISLM model in the open economy. The IS curve is downward sloping for two reasons. An increase in the interest rate reduces output both directly and indirectly through the exchange rate. LM curve is upward sloping. Given the real money stock, an increase in output increases the interest rate. Equilibrium output and the equilibrium interest rate are given by the intersection of the IS and LM curves. Given the foreign interest rate and the expected future exchange rate, the equilibrium interest rate determines the equilibrium exchange rate as shown by the interest parity relation. Figure 20-3 shows the effects of an increase in government spending in an open economy with flexible exchange rate on output, the composition of output, the interest rate, and the exchange rate. Economy is initially at point A. Increase in government spending G causes IS curve to shift to the right to IS prime. LM does not shift. New equilibrium is at point A prime with a higher output Y prime and a higher interest rate I prime. In panel B, the higher interest rate leads to an increase in the exchange rate. So an increase in G leads to an increase in output, an increase in the interest rate, and an appreciation. What happens to the composition of output? Consumption increases because of higher output and income, and government spending increases by assumption. Effect on investment is ambiguous, just as it was in a closed economy, because output is higher, which increases investment, but interest rate is also higher, which leads to lower investment. Increase in output and appreciation combine to decrease net exports. Higher output increases imports, while the appreciation decreases exports and increases imports. So an increase in budget deficit due to increase in government spending leads to a deterioration of the trade balance. If there was trade balance to start, then budget deficit leads to trade deficit. Figure 20-4 shows the effects of monetary policy in an open economy. A monetary contraction leads to a decrease in output, an increase in the interest rate, and an appreciation. Monetary contraction shifts LM curve up to LM prime. It shifts neither the IS curve nor the interest parity curve. Equilibrium moves from point A to A prime. This version of the IS-LM model for the open economy was first presented by the economists Robert Mundell and Marcus Fleming. Table 1 shows the emergence of large U.S. budget deficits from 1980 to 1984 as a consequence of tax cuts initiated by the Reagan administration. Budget deficit increased from 1.8% of GDP in 1980 to 4.5% of GDP in 1984. An expansionary fiscal policy was being pursued because of belief in the supply-side economics that tax cuts lead to increase in work hours and productivity. Table 2 traces major macroeconomic variables from 1980 to 1984. We must remember that contractionary monetary policy was instituted in 1979 to control inflation. The effect of the contractionary monetary and expansionary fiscal policy was just as it was shown by figures 20-3 and 20-4. It worsened the trade balance from negative 0.5% of GDP in 1980 to negative 2.7% of GDP. By mid-1980s, the main macroeconomic policy issue had become that of the twin deficits, the budget deficit and the trade deficit. The twin deficits were to remain one of the main central macroeconomic issues throughout the 1980s and early 1990s. Countries that choose a fixed exchange rate regime maintain a fixed exchange rate in terms of some foreign currency. The exchange rate can be readjusted. The term used to show increase in exchange rate is revaluation and a decrease is called devaluation. The Eurozone countries which have adopted the common currency, the euro, represent an extreme form of fixed exchange rates. Their exchange rate is fixed at 1-to-1 between any pair of countries. Equation 20.6 shows that in the presence of fixed exchange rates and perfect capital mobility, the domestic interest rate I has to be equal to foreign interest rate I star, implied by the interest parity condition. The money supply has to be altered such that the domestic interest rate at which the financial market is in equilibrium is equal to the foreign interest rate. Under fixed exchange rates, the central bank gives up monetary policy as a policy instrument. Figure 20-5 shows the effects of a fiscal expansion under fixed exchange rates. Under flexible exchange rates, a fiscal expansion shifts IS curve to IS prime and increases equilibrium output from YA to YB. Economy moves from point A to B. Under fixed exchange rates, money supply would have to be increased, shifting LM to LM prime to keep interest rate from going up, and output will increase from YA to YC. Economy will be at point C. So under fixed exchange rates, fiscal policy is more powerful than it is under flexible exchange rates. This is because fiscal expansion triggers monetary accommodation. As you saw before, fixed exchange rates imply that interest rates are the same in those countries. As part of the European Monetary System Agreement, member countries had to keep the exchange rates fixed within a certain range. Table 1 shows how France and Belgium, as a result, had to keep the interest rates high, close to the German rates, in order to be part of the European monetary system, even though their economies were not doing well and inflation was not a problem for them. Germany was experiencing inflation and increase in demand because of reunification of East and West Germany.